Okay, let's do some questions to help emphasize some of the exciting stuff in bonds we've learned so far. Question number 1. It says, what are the total amounts of serial bonds and debenture bonds? Oh, what is a serial bond? Everyday installments. It is a bond that matures in installments. So that $1 million, instead of getting it at the end of the term, I'm going to get 200, 200, 200, 200, 200,000 a year for 5 years is $1 million. That's a serial bond, installments. What is a debenture bond? Dentures, bad here. No, it's an unsecured bond. All right. Hancock's December 31st balance sheet contained the following items in the long-term liability section. Unsecured, secured. What are unsecured? Debentures. So 9.375 registered bonds, 250,000 maturing annually. That is an installment annually. That would be serial bond, 275. 11.5% convertible bonds callable beginning in next 11, due in 23. That's the end of the what? Term. Secured, 9.875, due 23. That is end of the term. And 10% commodity-backed bonds, 50,000 maturing annually, installments. That would be serial. What are the total amounts of serial bonds and debenture bonds? So unsecured or debenture, which gives you 275 and 125, which is 400, which is unsecured. So that's going to be debentures. So it's either A or C. Okay. Now, what about the serial bonds? That's annually, which is 275 plus 200, or 475, which is answer A. So notice 475, 400, answer A. Now, if I got a question like this and I had no clue, as I look down the choices, and this is kind of a cheat sheet way, it doesn't always work, but if I were clueless, I go 475, 475, 450, 200. So they have two 475, so it's probably one of those. Then they have 400, 125, 400, 650. They have two 400s, so it's probably a 475 and a 400 because they got them twice in each column. Oh, we love that. Now, when they add a third column, messes everything up. So if you ever get this, again, I'd rather you just understand the answer. If you're clueless, hey, at least it's better than just guessing. Next question, number 2, last sentence first. At June 30th, X3, what amount should King recognize as gain before taxes on redemption of bonds? So what are they doing? They're redeeming the bonds, or they're calling back the bonds. They're retiring the bonds. Okay, now, bond retirement, what is it? It's the opposite entry. Whoop. So bonds payable, get rid of premium or discount, get rid of amortized BIC. You pay some cash, difference is gain or loss. Now they said ignoring taxes. Why? Because if it's an ordinary gain or loss, then you would just put it in at gross, take out taxes later. And I'll show you this when I teach you deferred taxes. If instead it is an extraordinary gain or loss, then you would take net of tax. If I had an extraordinary gain of $100, government says, beautiful, you made 100, you owe me 30. What am I left with? Net of tax, 70. Here they said, forget about tax, just give us the number. Okay, they want to know what? How much is the gain before tax? All right, on June 30th, King Co. had outstanding 9%, $5 million face value bonds maturing on June 30th, X8. Interest was payable semi-annually every June 30th and December 31st. King did not elect the fair value option for reporting financial liabilities. So don't worry about fair value, do regular bond accounting. On June 30th, after amortization was recorded for the period, the unamortized bond premium and bond issue costs were $30 and $50 respectively. Now I circle the word respectively because I want to make sure you understand it. Again, I have a lot of international students. English isn't their first language. Respectively means the first word goes with the first dollar amount, the second word goes with the second dollar amount. So it said unamortized bond premium and bond issue costs were $30 and $50 respectively. So unamortized bond premium is 30, bond issue costs are 50. On that date, King acquired all of its outstanding bonds on the open market at 98 and retired them. Now, two things. They reacquired all. What does all mean? 100%. What if they only got back 60%? Then only get rid of 60% of the premium or discount, 60% of the BIC. See what I'm saying? Because you still have some bonds outstanding. But we got rid of all, which is what? 100%. And we paid how much? 98. What does 98 mean? 98% of face. Now, how much is face? 5 million. What's 98% of face? 98% of 5 million. All right, so let's go through here. We had what? we had unamortized bond premium. Boom. So let's get rid of the discount. All right, first of all, get rid of bonds payable. How much? $5 million bucks. I'm going to leave the zeros off. It said we paid 98% of this, which gives you $4.9 million. Unamortized premium, unamortized BIC. Unamortized premium was 30 and unamortized BIC was 50. So premium is 30, BIC is 50. Okay, so by doing the journal entry, the answer just falls into your lap. So what we're saying here is we've got $5,030,000, $4,950,000. To get from $4,950,000 to $5,030,000, we need another 80. So how much is our gain? $80,000, which is answer B. Gain 80. Next question. What should be the issue price for each $1,000 bond? How much is the issue price for every $1,000 bond? All right. The following information pertains to Campco's issuance of bonds on July 1st. Now, I'm going to show you a quick word. July means what? You lie. July, you lie. How do they lie? Because quite often with July, that is middle of the year. So July, you lie. Think of half a year. Okay, just in case. May or may not relate to this question, but July, you lie. All right. Face amount, $800,000. Term, 10 years. Stated interest rate, 6%. Remember, that's 6% of the face. That's the interest we're going to get. That's the cash. Interest payment dates, annually, July 1st. Yield, 9%. Now, what is the yield? The yield, the market, the effective is 9%. So I want to earn 9, but they're going to pay me 6. What is that, a discount or premium? They're going to pay me 6, but I want to earn more. You better charge me less. That's a discount. Very good. All right, present value of 1 for 10. So now they give you the present value factors. You need to pick the right one to use. Present value of $1 for 10 periods. Okay. Future value, we rarely use that. Present value of ordinary annuity, that's for the interest. So we'll need to use that. All right. And they want to know, hey, how much, what is it? What should be the issue price for each $1,000 bond? How much cash are we going to get? All right, so basically we're doing a bond payable. We're going to issue the bond, but the bond payable is going to be for one bond. So it's going to be bond payable, 1,000. Now we're going to get some cash and we're going to have some discount. How do I know it's a discount? Because it's paying me 6 and I want to earn 9. Now remember, when you're present valuing, let's come back over here. Remember here we did the present value earlier? It's paying 8, that's stated, 8%. But I want to earn 10, you then present value at the effective rate, the rate you want to earn. Okay, that's how you present value it. So in this particular case, what's it say? It says it's paying me cash of 6%, but I want to earn 9. So how much is it paying me? $1,000 bond, it's paying me 6%. So a $1,000 bond, if I want to use this setup, it's $1,000 at 6%. It's going to pay me $60. So I have to present value this and this. So it's $1,000 present value of a lump sum in, how many years was this bond? The bond was 10 years. 10 years, and I want to earn 9%. So what that tells me is the present value, 1,000 present value, 9% is 0.422. 0.422 times 1,000 is what? 422 bucks. Okay, got that. That makes sense. The next one is present value of an annuity. Now, what is the annuity that I'm getting? I'm getting $60 at 6.418. So that's $60 at 6.418 is, I think, what I said. At not 60%, at $60. 6.418, 60 is 385. When you add this plus this, that's 4 and 3 is 7. That's 807. 807. So 807 is the cash. Discount would be 193, and that would be my journal entry. So how much? 807, Answer C, as in C, senor. So what is that telling you? It's telling you again that what we're doing is we're present valuing two things, the bond and the interest. The bond present value lump sum, 10 years, 9%, boom, is 4.422 is the factor, 1,000 is 422. So in other words, if you're going to give me $1,000 in 10 years and I want to earn 9%, I should put $422 in the bank today. It'll grow to $1,000 in 10 years at 9%. Over here, 60, 10 years, and I want to earn 9%. That's going to be an annuity, is 6.418. That means that if I'm going to get 60, 60, 60, 60, 60, 60, I'm going to get 600 bucks, right? 10 times, 600 bucks, but it's really only worth 385 because of the time value of money. When you add them up, 807, that's what I should charge as far as getting. That's how much cash I should get from issuing